Good morning, everyone. Welcome to this webinar organized by ESMA. So please be informed that the webinar will be recorded. You are all muted by default with your cameras disabled, but you will be able to raise any questions you may have after the presentation via the Q&A box. So colleagues, the floor is yours.
Thank you so much, Cicely. Warm welcome also from my side to this call today. It's a true pleasure for us to welcome you today to our webinar that we are holding on the occasion of the report on total costs of investing in UCITS and AIFs that we just published. This report is very dear to us. And we are particularly pleased to have an opportunity today to share with you a few of the insights that we have published and to discuss with you what we found and what we can make of it. It's really a great pleasure to see so many of you joining us today. Your strong participation actually underlines how important and relevant this topic is. It reflects the fact that the understanding of the costs in the fund businesses goes truly beyond being a pure technical question. It is key to a number of market considerations that we have, in particular from the perspective of the citizens, of the investors, because it's about the costs that they incur when buying investment fund products. And it is also super relevant from a policy perspective, because we see in many areas of the policy community these days projects being discussed that relate in many ways to the fund business itself, and with that to the cost that we have in that business. We, for the first time, have conducted this comprehensive assessment of total costs borne by investors in UCITS and alternative investment funds across the European Economic Area. And we are combining data from both manufacturers of the funds and the distributors. And this is the first time this has been done in such a comprehensive way, and not only in a comprehensive way, but actually also on the basis of data that we collected in a dedicated manner from market participants in cooperation with national competent authorities, in order to get that broad view of the costs, not just of producing the funds, but actually answering the question of how expensive is it to get the fund product once it has been produced into the retail investor, into the securities portfolio that they have. This has provided us with an unprecedented view on costs and their structure and how they actually impact the end investor in this game. We will see the findings in a minute. Tanya will present them to us, but I think it's fair to say at the beginning that in terms of the distribution costs, which is a real novelty in the way we're presenting this, we see that almost half of the total costs, for example, for UCITS funds, are actually attributable to these distribution costs, and over a quarter for alternative investment funds. Second, inducements play a big role. Inducements, or is the payments from fund managers to distributors, remain a common practice and account for around 45% of the ongoing costs for UCITS, for example. And then third point, also very important, while digital platforms and neo-brokers still play a small role in the overall market, they are growing rapidly and they offer new lower cost ways for investors to access the market. So this report helps us to understand the cost overall, but it also helps us understand why costs actually differ. And there are many reasons. For example, differences across fund types, differences across distribution models, and also differences in investor profiles. And these insights are essential for actually strengthening investor protection and ensuring that Europe's capital markets remain fair, transparent, and competitive. Our findings are also relevant for regulators and market participants alike. They provide valuable evidence to inform ongoing policy discussions, no matter whether we talk about RISE, no matter whether we talk about SIU, on how to strengthen investor protection and value for money in EU fund markets. And finally, from an economic perspective, and also that from final investors, retail investors like you and me, understanding costs is crucial. Even small differences in annual fees can compound into large effects on long-term returns. And transparency in the cost structures, therefore, plays a big role in supporting efficient markets and building investor trust. Our discussion today will explore these findings in greater detail, and it's a great pleasure to have that opportunity. But before I leave the floor to Tanya and my colleagues, let me take a moment to thank all of the colleagues in ESMA who contributed to this very important work and were involved. Also, all the colleagues in the national competent authorities, because they helped us gather the data and discuss many of the conceptual questions of analyzing the costs, and all the entities that actually did provide the data and the insights, so market participants and a number of stakeholders, for their continued engagement and the dialogue. This has been a genuinely collective effort for all of us across the European supervisory community and the market. So this is the outcome of an important activity, and I invite all of us today here on the call to engage in the discussion, to ask questions. Please feel invited to share reflections and contribute to the constructive dialogue that we have on this important topic. Thank you once again for joining us. I wish you a very interesting and informative event. And I now have the pleasure of handing over to Tanya de Renzis. Tanya is the senior economist who is in charge of the project and who led the analytical work, but also the coordination work on the project. Tanya, over to you. Thank you so much.
Thank you, Stefan. And thank you all for being here. So as Stefan just said, let's get into the report. I hope you can see the screen, probably not. Just give me 1 second just to, yes. So I hope everybody sees our screen, my screen. And let me get directly into the results and the finding of this report. As Stefan said, this was a pretty important piece of work for us, but in general, in terms of the amount of information that we were able to identify and that be useful for investor and retail investor in the region in Europe. So just ahead of explaining these 8 key findings, on which I'm going to go also on details, I'm just going to provide you with some background on the mandate and why we started this work. And also for conclusion, I'm going to provide you or integrate what Stefan just said on the contribution of this report and the main conclusion that we were able to reach. For the work of the report basically started with the AFMD and UCITS directive review from the European Commission, and we were tasked as ESMA to provide a report identifying the total cost of investing in UCITS funds and investment funds, in particular the cost that UCITS management companies and alternative investment funds manager charge to investor. But as I said, it's the total cost, so direct and indirect type of costs. In order to do that, we had to run a proper data collection on which, as also Stefan just said, we collaborated with competent authorities to collect data both from the product side of costs, so costs inherent in the financial product, so funds, and costs related to distribution. As you all know, this is a very important step for us because we have been publishing our annual cost and performance on analysis of cost of funds, but distribution costs were not possible to be analyzed. And this is what we do with this report. Overall, what we collected, our sample is more or less 10 trillion between UCITS and AIF, 7 trillion in terms of net asset values for UCITS funds. That is 66% of the European market. And of this 7.2 trillion, 3.3 trillion of net asset values are distributed within the European economic areas. So the focus of this report is, in fact, just those funds that are distributed within the area. And almost 86% basically of UCITS are indirectly distributed, most of them by credit institution and investment firms. I'm going to go in details on this just later on. In terms of alternative investment funds, we cover 2.6 trillion in terms of net asset value. So the 38% of the market as identified by IFMD. And of these, around 1 trillion is distributed within the European Economic Area. And also, in this case, most, in terms of indirect distribution, most of it is concentrated in credit institution and investment firms. So ahead of going in detail into the findings, let me just provide you with an overview of the main findings we have in this report. So first of all, as I already said, most of the distribution in the European Union and European Economic Area is through credit institution and investment firms, while we talk about indirect distributions. In terms of cost, so total cost that includes product cost and distribution cost, the range varies according to, first of all, UCITS and AIF, with AIFs being more expensive than UCITS. But also within each of the universes, cost varies according to the asset type, the management type. So for example, for UCITS, we have a range between 0.5% of the amount invested for funds focusing on bond assets and being passively managed, to 2% for funds focusing in equity and being actively managed. For AIFs, costs are higher, so they go for 1.4% for the AIF type that are categorized in IFND as others. So are those type of funds that focus more on traditional type of assets, so let's say equity or bonds, to 2.8%. And this cost relates to real estate funds that are the most expensive. Also, an important finding of this report that we haven't been able to do with the previous report, with the recurrent reports that we have on cost, is the possibility to look at actual entry and exit fees besides the maximum entry and exit fees, or as I say here, we say here one-off fees that are reported in PRIPS. This is important because also in our annual sort of analysis, we always highlight the issue that usually exit or one-off fees are the results of bargain. And so it's important to see if maximum fees, the relation between maximum fees and actual fees. And what we identify is that actually maximum fees, they do not necessarily reflect actual fees. In terms of distribution costs, this was already highlighted by Stefan. So distribution costs have a very substantial share, especially for UCITS. So 48% of total cost is taken by distribution cost. For AIF, this is a little bit lower, and there are differences according to or the provider distributor, but I go into detail later on. Also, Stefan also mentioned this. So inducement agreements are pretty widespread, and the inducement payments from manufacturer to distributors accounts for 45% of the ongoing cost of those costs that are paid from by investors. Again, we're going to go also to look at the different type of costs, or the reasons why a cost differ. And even if the focus of the report is really at the aggregate level, so on the entire European area, we identify that there is high heterogeneity within the area. And this is a question in terms of integration in the market. Finally, we highlight basically how important is to have information on cost. This information is there between PRIPS, a KID, or MiFID, so it's either reported or disclosed, but it is not easy, especially for non-professional investors, to navigate through the amount of information available. So in terms of the type of dominant distributed channels, as I said, we're focusing here on indirect distribution mostly. So for UCITS, as I said, almost 90% is taken by indirect distribution. And of these, if you see the bottom right chart, more than 60% is of the distributing channel is taken by investment firms and credit institution. Credit institution here, it's the 37% of the overall 86% that we see on the bottom left-hand hand chart. So moving to analyze costs. So the improvement, or I mean the achievement of this report is the possibility that gave to us to analyze the total cost that investors are paying. So both product cost, that is the blue part on the bars, and the distribution cost. So we distinguish here as between UCITS and AIFs. And the focus, in particular in the slide that you see here, the focus is on equity for what concerns UCITS. And this was to provide you with the differences that we see according to the type of management, so active, passive, and ETFs, and the role then the distribution costs have on this particular type of investment. So first of all, on average, distribution costs, they account for almost half for what concerns UCITS of the overall costs. But the role of distribution costs, it's even more prominent, for example, in terms of the share that they're taken up from the total cost. When we're looking at passive and, for example, ETF funds, equity funds, because here, of course, given that the product costs are so low, then the share of distribution cost of the overall cost paid by investor is pretty high. Also, when we're looking at AIFs, costs are generally much higher, but really the difference, the rise comes from product costs rather than distribution service costs. Looking at the exit and entry fees, so the one-off fees, as I said, as I mentioned, we were able for the first time to see the difference between what is reported in PRIPS, that are the maximum level of fees, and the actual fees applied. Now, this data, they come from the manufacturer. So what Mancos or managers, or this is actually what Mancos provided us, what information was provided to us from Mancos. That means that not all the time Mancos have a visual on the cost, because sometimes one-off costs, they are paid directly from investor to distributors, so manufacturers of products that don't have this kind of information. This is why in the chart you see two series of dots, so the green and the blue one, because the green, they include all the sample that we had of actual fees, including also what was reported as zero. So when the manufacturer basically told us that the cost, the actual one-off fees was zero. The blue series that you see of dots are instead, it's a subsample, meaning we exclude both zero values and those values that were not reported, because it may be that when the because in some cases when the manufacturer reported 0 as cost, probably it was just because they didn't have the information. So this was just to provide you with provide in general the reader with an overall view of the range that we could have. And in fact, but what we see is that when we, for example, for UCITS, when we include one-off fees equal to 0, we have a reduction in the cost when we move from maximum to actual fees of 96%. Instead, when we do not include the 0 level, we have a reduction of 38%. Either way, even if this range is pretty large, either way, what we observe is that the maximum fees that do not reflect the actual fees applied and paid by investors. In terms of what we were able to do was also to look at the breakdown of distribution costs. So we distinguish between advice costs, transaction costs, and all other service costs that includes portfolio management and also all other service costs combined, because we might have as a residual that the distributor provides different type of services. Now, I think it's important to say is that in our sample, a quite good share of the services provided is non-advised. So we have 30% that is non-advised and 30% that it's advised, and of this 27% is non-independent advice, and 3%, I hope I'm not mistaken, is independent advice. But I think from this, the type of services, I think what it's important to, as the main message is that investment firms and credit institutions, the advice cost, it's pretty high. Also, when we look at all other service costs, that it's quite an important share of the overall distribution cost. This includes also advice, and because in the all other service combined is some sort of a residual, and so they may include also advice, portfolio management, and all other services. Overall, also neo-brokers that you see here, neo-brokers, they don't provide advice, but irrespective of that, for the sample of neo-brokers that we have in our analysis, costs are much lower compared to traditional type of intermediation and distribution channels. For AIFs, we don't have, we have just credit institution investment firms, with investment firms having a larger share of distribution costs. Now, as also what it's important and what we could do as an important analysis is the analysis of inducement. So we observed that inducement agreement is pretty widespread in the EU, and what on average manufacturers, they handed 45% of the ongoing costs that they receive from investor to distributors in terms of UCITS. When you look at AIFs, this is a little bit lower, is 34%. However, we see quite a bit of heterogeneity in the level of inducement when there is no inducement ban paid from manufacturer distribution across member state. And this depends also from the different distributing channel that is, or also a bit of the data that they provided or manufacturer provided to us. So now focusing on cost driver, we can distinguish between cost drivers related to product cost, and then I'm going to focus later on cost driver related to distribution cost. So regarding cost drivers on product costs, and we focus on ongoing cost here, this is basically what it's just confirming what we have been observing over the years in our cost and performance reports, market reports that we publish every year. So for example, in terms of asset classes, if we're looking at funds, so the baseline here is equity funds. So when costs are higher, if for funds that focus on alternative type of assets rather than bond assets, or in terms of client type, retail investor usually pay higher cost than institutional investor. Again, when we look at management type, active funds or actively managed funds are more expensive and passive on ETF or ETF funds. This is something that we already have been observing and studied over the last 7 or 8 years. Now, focusing on distribution costs. So we have two types of analysis. One analysis that comes from a qualitative survey that we run with distributors that is identified in the histogram that you see in the bottom left-hand side of the slide. And here, basically, we ask distributors to identify what they thought were the strongest drivers, looking at client loyalty or wealth or the amount invested or holding period. And what we could extract from that is that what we saw is that the strongest driver are related to the amount invested and also the holding period. Also, partially, client wealth is important, especially when we look at credit institution investment firms. On the bottom right-hand side, instead, we're looking at the different type of channels. So we look at credit institution investment firms, and we also look at neo-brokers by type of service offered. So if it's not advised, so execution service, advised, independent or non-independent, portfolio management, and several service combined. The color, so the red, the darkest pink color identifies costs that are higher, while the lightest pink is when costs are lower. Also, for neo-brokers, you see in this sort of heat map, the white rectangles. There, it means that the service is not provided. So what we observed, that is also what I said before, is that advice and when you have several service combined that can include also advice, are basically identified with the highest level of distribution costs. And overall, neo-brokers, they have lower costs compared to traditional intermediation. This also, it's related to structural factors also because of the different business model between digital-only platform and more traditional type of distribution channels. So, as I said, the focus of the report is the EEA, the European Economic Area, but we, in any case, wanted to see or to identify if the level of heterogeneity in both products cost and ongoing and distribution cost. So what we look at, I just focus on distribution cost here, is that when we look at credit institutional investment firms, the heterogeneity is pretty high. You can see the whiskers here, irrespectively really of the type of assets. Probably equity is larger than bond, and overall for investment firms, the heterogeneity is higher. But I think what it's important is really how large this heterogeneity is. While for neo-broker, this is different. This is related also from one side on the sample, because we have a way smaller sample of neo-brokers distributors, but also because, as I said before, of the business structure different in the business models of digital platforms. Just to conclude with, I think this is more an overarching message that we can take out from the overall analysis, is that with this report, we observed how important is to have a larger set of information, in particular on distribution costs. Because so far, as I just said, so the ESMA annual market report on cost and performance was built on PRIPS kit data. And so is ex-ante information is mostly focused on the product component. Even if distribution costs might be included in management fees, but it's not not clear, and the distribution costs are not always there. So it's an important aspect that we couldn't analyze before. Also, in terms of the retail client perspective, so the availability of information, cost information is there. There is ex-ante, ex-post information through PRIIPs, KID, and MiFID. But navigate through PRIIPs and MiFID disclosure, or disclosure across different type of pieces of legislation, and not being fully harmonized is complex and not easy, especially in case of non-professional investors. So just to wrap it up, as also so Stefan already mentioned, this is the first time comprehensive assessment of total cost. It allows us to have visual on the importance of distribution cost, inducement agreement, and also the importance also in terms of heterogeneity, even if it's not the focus of this report, because it points to gaps to internal market. It is important, I think, also to highlight that further analysis could be done. Of course, this depends on data availability or resources availability, but it would be interesting, for example, to focus on to focus more on the insurance sector as distribution channel, that it was not the focus of this report really, or on the role of new entrants and additional data. It's important on this respect, but also more in-depth analysis in really the breakdown of distribution-related analysis. So I think I provided you with an overview of the results and the conclusion of the report. So I think we can go ahead with any question of the discussion. I leave the floor to Claudia, that's going to moderate the follow-up.
Thanks a lot, Tanya, for the very clear presentation. The report is very rich. You can find it on our website, so there is even more analysis than that has been presented in the last 30 minutes. Now it's time for questions. If there are questions, I can't see actually any questions. You can use the Q&A tool to ask any question. You can just write there the question you may have. I think that your presentation was very clear. So for the moment, there are no questions. There is an hand raised, but I'm not sure that you are allowed to speak. You can try, but I'm not sure. If you can write the question, that would be better. Okay, I can see one question on, yes, a very good question on the inducement. Let's say what was the percentage of the funds that were affected by inducement, more or less?
So overall, we saw that when we looked at indirect distribution, between 40–50% of the overall funds distributed in the EEA reported inducement. So we're paying inducement. This is what we could see from our analysis. I think it's, yeah, this is the overall average.
Okay. Thanks.
For UCITS, focusing on it.
Yeah, for UCITS indeed, because as Tanya highlighted during the presentation, of course, the data set is very rich. There is a lot of heterogeneity, and so we need to take into consideration all of these differences. In terms of where the distribution costs were, let's say, the highest, as Tanya said, the report is about EU analysis. Of course, we looked also into country level analysis, but we this is not the objective of this presentation today, but maybe Tanya, you can give some example in terms of type of distribution. That is a bit of the slide that you had also already.
So yes, so in terms of, so the focus is really at aggregate level. But for example, in terms of funds, as I said before, for example, funds that are passively managed or ETF funds, in that case, we find that the share of distribution cost is more than 50% in some cases, because product costs are extremely low. So the role of distribution cost is necessarily higher.
Okay, yes, thanks. So there is a question on if this will become a regular report. The reply, I can reply to this one. The reply is no, not for the moment, for sure. So we will continue to publish our cost and performance report that we have been publishing for 7 years now, and we will have the next one in the first quarter 2026. At the same time, this report was really one-off, was based on a data collection, one-off data collection. So for the moment, we are not planning to repeat the exercise. There is also a question around, if I understand correctly, this is about the PRIPS one-off fees. Tanya, maybe you want to comment on this?
Oh, sorry, okay.
So a bit the difference between product and distribution cost in contrast to PRIPS kits. So the fact that PRIPS kits doesn't include all the cost sources, basically.
Yeah, so it is true. So the focus, it was on MiFID. We got the MiFID information from the distributor. So necessarily was what it was actually the actual fees that were applied once the investment was made. So when we requested the data, because we have two types of data collection that I think it's detailed also in the report. One is from manufacturer, from which we had PRIPS kit type of information, and one from distributors that's based on MiFID information. And we look at MiFID mostly ex post. So the information, so the data, that the costs that were actually paid from investors. And this is why you see this difference between having PRIPS kit data and MiFID data. It's simply because we have two data collection, one from manufacturers, so PRIPS kit, because they're required to report PRIPS kits, and one from distributors. And in the PRIPS kit one, you might have, for example, distribution costs embedded in management fees, but you don't see them as a standalone. Or it might be that distribution costs are embedded in one-off fees and you don't see them. Sometimes you don't see them from manufacturers, you see them from the distributors, or it's a mix of the two, but it's not clear. That's the difference.
Thanks, Tanya. There are a number of questions on country-level data, country-level analysis, a couple of questions relating to the example of the Netherlands, whereas we all know there is the ban on inducement. And we report on that also in the cost and performance report. As I was saying at the beginning, this report is really at EU level without any specific reference to any country. So I think, yeah, on this one, that would be the reply. A very good question on the analysis of independent advice versus non-independent advice. Maybe Tanya, you want to say a few words about this?
Yeah. So regarding, as I said, non-independent advice, we see it as more expensive than independent advice. Now we also try to do an analysis, but we put this in a box on pure independent advisors, basically, but the information on that was that it's scarcer. That's why we included it in the box, and I think it is actually an avenue for research, for further research, to identify really to see the role of independent advisors and the benefits or risk that we can have from that perspective. Also, what it's also important to potentially to investigate is, for example, the type of product offered or the differences between independent and non-independent advisor. But this, it's sort of, I'm going a little bit in avenues for further research that would be interesting, especially from an investor protection perspective.
Yes, thanks. And then there are a couple of questions, let's say, in terms of next steps or going forward, what we will do based on this analysis. Let's say that this report is an analytical report. So the objective is really to give a technical insight, evidence-based insight to the ongoing policy discussion related to, and also to contribute to the transparency of the cost information in the market. The impact on the next cost and performance report, we are in the middle of it, so we are now working on the new cost and performance report. This is the annual exercise, and one potential impact will be, and I think Natasha is in the room, but will be that we will focus mostly on the ongoing cost, and we will probably give much less importance to the one-off fees, given the results included in this report. And with the data collected for this exercise, what we're planning to do, I mean, the first objective was to publish this report, and then we will discuss also with our national authorities that were very helpful to help us to run this data collection. Without them, we wouldn't have been able to run this exercise actually, and we will see what else we can do with this data, because indeed the data set is very rich, as we said. Okay, I think we replied to all questions. So thanks a lot. Thanks a lot to Tanya, Natasha, Lorenzo, and all the colleagues in ESMA that helped us to draft this report. And thanks again to the national authorities. And thanks to all of you for joining this webinar, and have a very good day. Thanks.
Bye. Thank you.